If you've got $25 a week, you're a lot closer to building real wealth than you think. I'm not talking about trading hype coins or guessing the next meme stock, because with only $25 per week, you can start building a portfolio that, over time, has the potential to pay you thousands of dollars every single month in dividends. No gambling, no day trading, no buy this one secret stock now. Just a simple strategy investors actually use, but rarely explain clearly. In this video, I'll walk you through what DRIP is, how to upgrade it, what kind of stocks to look at, and how a tiny weekly amount can snowball into a serious income machine over the long term. And just to be clear, this is not financial advice. You make your own decisions. All right? Grab your $25. Let's start. Everything that works in life has a strategy behind it. Gym, diet, business. Investing is the same. Our goal here is simple. Build a future where your money pays you every month. Our constraint, we've only got $25 a week to invest. That's about $100 a month, $1,300 a year. So the question becomes, how do I make a small amount actually matter? The answer is, use DRIP and time. So what's DRIP? DRIP stands for Dividend Reinvestment Plan, but don't worry about the fancy name. Here's the idea. Some companies and ETFs pay you dividends, cash rewards for owning their shares. With DRIP turned on, you don't take that cash out. You automatically use it to buy more shares. More shares give you more dividends. More dividends buy more shares. More shares, yeah, you see it. It becomes a loop. Let's do a super simple example. Imagine a stock costs $20 a share. It pays $1 per share each year. That's a 5% dividend yield. You start with 100 shares. End of year one, you get $100 in dividends. Most people take that $100 and spend it. You don't. You turn on DRIP. That $100 automatically buys 5 more shares at $20 each. So now you own 105 shares. Next year, same dividend, $105. Reinvest again. Now you've got 110 shares. Next year, a bit more. Next year, a bit more. And that's assuming the dividend never grows. In real life, good companies often increase their dividends over time. Now let's talk about your $25 a week. On its own, that number doesn't sound crazy, but consistently invested and reinvested, very different story. If you invest $25 every week into solid dividend-paying assets and you reinvest everything for decades, you are using 3 tools at once: time, compounding, and discipline. The math goes like this. If your portfolio earns around 8 to 10% per year on average over the long run, the $25 a week can grow well into 6 figures after 30 years. If your mix includes quality dividend growers and you manage to do better than that, the numbers can move toward multiple 6 figures. Is that guaranteed? No. Is it realistic with the right assets, patience, and no panic selling? Yes, absolutely possible. Now here's where we upgrade the basic DRIP. Traditional DRIP, you already own shares, they pay dividends, those dividends buy more shares. Supercharged DRIP, what we're doing here, you reinvest dividends and you keep adding $25 every single week, no matter what the market is doing. This does 3 important things. First, it speeds up compounding. Second, it uses dollar cost averaging. When prices are high, your $25 buys fewer shares. When prices are low, your $25 buys more. Over time, you get an average cost that smooths out all the drama. Third, it makes the process automatic. You don't sit there guessing, is today a good day? You decide once, then you let the system work. But this only works if you're dripping into the right kind of assets. So instead of chasing random hype, I like to think in 4 simple categories. First, blue chip dividend stocks. These are big established companies that have been paying dividends for years. Think of names like Coca-Cola, Johnson & Johnson, brands you see in real life. They're not the fastest, but they're stable. They're the base layer of the portfolio. Second, dividend aristocrats and dividend ETFs. These are companies that have increased their dividends every year for decades, or ETFs built from those companies. They've paid through crashes, recessions, bad news, good news. This adds consistency and diversification. Third, high yield, but not stupid high yield. Here you add a small portion of stocks or REITs that pay higher dividends, like monthly payers or real estate funds. This boosts your income. But key rule, if the yield looks insane, you slow down and check the company. High yield with no real business behind it, that's a trap. Fourth, growth plus dividends. These are companies or ETFs that grow and also share profits. They may start with a lower yield, but if they grow earnings and raise dividends over time, your income on your original cost can become huge 20 to 30 years out. So, can $25 a week really lead to $5,000 a month? Let's walk through it slowly. You invest $25 every week. You stick to quality, you reinvest everything. You don't bail out in every crash. You give it 20, 25, 30 plus years. In a conservative long-term world, your portfolio might land in the lower end of 6 figures. If that portfolio pays you 4 to 5% in dividends, you're getting a few hundred to maybe $1,000 a month. That alone is already life-changing for many people. In a strong but realistic growth world, you pick solid dividend growers, you stay in, your average annual return is higher, your dividends grow each year, and your portfolio climbs toward $400,000, $500,000, maybe more over a few decades. If by that time your holdings are paying you a high effective yield on your original cost because dividends have grown and grown, you're now looking at tens of thousands per year in dividends. That's where numbers like $5,000 plus per month become possible. Not in 1 year, not in 3, but over a long, disciplined timeline. The point is not to promise you a specific number. The point is to show you $25 a week is not nothing. If you pair it with drip time and quality, it can become something very real. So how do you actually start? Honestly, keep it simple. Set up your broker, turn on automatic deposits of $25 each week, build a watch list using those 4 categories, pick a handful of strong, diversified positions, turn on drip, and then let it run. You adjust, you learn, you refine, but you don't restart from zero every time the market has a bad week, because this game doesn't reward the smartest trader, it rewards the most consistent investor. Now, based on those criteria, let's build an example 5-stock drip portfolio. This is not a recommendation, just an educational illustration of how you could think. The 5 picks are NextEra Energy, Starbucks, Abbott Laboratories, the Home Depot, and the ProShares S&P 500 Dividend Aristocrats ETF. Right now, NextEra Energy sits at roughly a 2.7% dividend yield with a long track record of steady dividend growth and strong performance in the renewables and utility space. Starbucks is around a 3% yield, and while its growth has slowed compared to the early days, it still consistently raises its dividend. Abbott Laboratories offers close to a 2% yield and has been increasing its dividend for decades, backed by a solid, diversified healthcare business. The Home Depot sits in the 2 to 3% yield range and has a history of strong dividend growth supported by a very durable business model. And the ProShares S&P 500 Dividend Aristocrats ETF gives you a basket of companies that have raised their dividends for at least 25 years, with a yield a bit above 2% and broad diversification. If you split your money equally across these 5, you're looking at a starting yield somewhere around the mid 2% range, plus exposure to companies and an ETF that have shown they can grow both their payouts and their share prices over time. And that's the entire idea. For now, take that $25, give it a job, turn on drip, and start building the portfolio your future self will thank you for. If this helped you see investing a bit clearer, hit subscribe for more easy-to-follow breakdowns. Thanks for watching.